Today, I want to revisit a theme I covered recently, and that's tech leadership. You're looking at a chart of the Nasdaq. It's been outperforming the other indexes because of the big techs leading the way. And by the way, eventually, I will focus on some international and smaller cap indexes in the weeks ahead because they're also important to be holding in your portfolio. Okay, so let's take a look here. What is driving the Nasdaq in terms of performance? Well, we know, like I said, it's the big techs, and they have a cute little nickname now, FANMAG. Isn't that kind of funny? It's quaint, reminds me of when I was a kid and I read all those magazines about the teen heartthrobs back in the day. But no, that's not what that means anymore. Today's FANMAG stocks are Facebook. Let's take a look at this right here. There we go. This is the F in FANMAG right there. So you see that Facebook is kind of near its highs over here. It's kind of been in a little channel recently. I talked about that a few days ago, that it kind of pulled back on the news of some of the advertiser boycotts. Really has regained where it was before. It's basically at new highs right now. Okay, so then another A in this one is, bet you can guess it, Apple. That would be the first A if I type in the symbol correctly. Okay, so Apple. And you see here, same sort of thing. It's just below its previous high. So really, that is showing incredible leadership too. For all intents and purposes, we're going to call that at new highs. The NFLX, Netflix. Okay, definitely has been a COVID play here. People at home, movie theaters closed and so forth. Now this one did pull back a little bit on its earnings. There is a little bit of concern about some future growth, but nonetheless, you see this is, if I put this on a weekly chart, you can see right here, definitely, it's been a little choppier than some of the others, but in recent weeks it has rallied to new highs. And take a quick peek over here at some of the earnings estimates going forward. So that's Netflix. Then you get into the M of FANMAG. Bet you can guess. Microsoft. Okay, so this one has really been a powerhouse. I talked about that a little bit. It has a lot to do with the enterprise purchases, corporations buying from Microsoft with more teams working remotely. So we see that there. Now the A. And now our second A, which is Amazon. And just taking a quick look here, just recently pulled back from all-time highs. Again, for all intents and purposes, you can say this is at all-time highs right now. This is the stock everybody loves to hate right now, but apparently consumers are still using it like crazy despite all the bad press and the negativity surrounding the company. You do see this is the second A in FANMAG. Now on to Alphabet/Google. Kind of silly. The formal name of Google is Alphabet. And who calls it Alphabet? I don't think I've ever heard anyone call it that. But here you have Alphabet stock, also known as Google. So same thing. And you did see a little bit of, you did see some concern about advertising back in March. That's all rallied back. And Google actually is pretty much at all-time highs today. So that's the FANMAG. Now let's take a look at what that means in terms of driving the index performance. Now there's a lot of talk right now that these stocks are in a bubble. In other words, they're price inflated, destined to pop very soon and shatter all investors' hopes and dreams. And none other than Mark Cuban has been pretty vocal about that lately. And Mark Cuban is somebody to listen to. Now, is he right on this score? He may be. You can definitely say they will decline at some point. That is just the reality of the stock market. So we know that these highs won't last forever. And I can certainly make an argument that there are much more tumultuous times ahead with unknowns about COVID, a vaccine, the economy, job losses, the federal deficit and debt, the election, higher taxes, possibility of inflation. Plenty of room for worry. I know I've just depressed everybody there, but there's reason to be concerned. And it's important to note one very valid reason why some of these stocks are going higher. With interest rates near zero right now, the institutional investors have to put their money somewhere where it will get a return, and stocks are much more attractive than bonds for that purpose. And the thesis for these tech stocks is that the cloud won't go away. The pandemic underscored the necessity of these companies' products and services. We just talked a little bit about some of them. That will remain into the future. These companies aren't going anywhere. Let me show you one other thing, is the VIX here, which is called the fear index, okay? And you do see here that has been declining really ever since March, kind of hit a peak back here in March, April. And what this measures is really shorthand here. This is a way to look at how nervous investors are about what's happening right now, what they're projecting into the future. And again, I see room for nervousness. Institutional investors don't see that as much right now. Who's right? I don't know. In any event, I want to come back to the idea of the single stocks. Let's just pull one up here. It doesn't matter. Facebook. They are pretty frothy right now. In other words, they are at or near all-time highs. You really don't want to be betting on a stock that's at an all-time high. Better to wait for some kind of pullback to a moving average where you can see support. And also watch the market sentiment. So if that VIX starts to go higher again, or if it seems like we're back in some kind of free fall, you might want to avoid new buys for the moment. Wait till the market seems to be stabilizing, and then you're seeing those stocks get back to their moving averages again. Let me show you what I mean about these moving averages. So if you kind of look, you see the red line right there on the screen. That's the 50-day moving average, and we're looking at Facebook right here. You see it kind of pulled back right there, found some support, trended along the 50-day, came back, crossed above the 50-day, and that's good. When it crosses above that line, it does show you more confidence on the part of the institutional investors. Pulled back again here recently, found some support right there. Let's go to Microsoft and I can show you the same thing. Just a little tutorial on chart reading here. Oh, so this is great. You see, pullback. This was back here in 2019, found support. And the lesson is the same regardless of when it happened. Okay, a little more right here along the 50-day, along the 50-day. Traversed along that line. Then it pulled back into sort of a double bottom pattern right in here. Undercut that 200-day line, but has been riding above that. So basically what I wanted to say about the moving average is, boom, when it finds support right along there, unless it's some discernible pattern like the double bottom right there, when it finds support along that 50-day, that could be a place, if the market is in an uptrend, that you might want to consider entering, okay? But I really like to show you some of these indexes because it really is the concept of diversification in a microcosmic way, even within the world of large cap domestic stocks. And you can see some sectors are pulling the train while others are lagging. Let's take a look at that right now. Okay, so here are the S&P. In other words, the American stock sectors and industries. This holds true for global regions as well, but what this page we're looking at Fidelity right now does refer specifically to the US stock market. So you do see the sectors here year to date. Energy down 40%, financials 22%, industrials, so on and so forth, consumer staples, materials, utility, real estate. Little surprised at consumer staples, by the way, but that's not a terrible decline, 3.35%. Real estate, 10.46%. Okay, but let's take a look at what's leading the way. You've got healthcare, communication services, consumer discretionary, and information technology up 20%. So you do see you need to have all of these sectors in your portfolio. Now you may be saying, Kate, well, wait a minute. I only want the ones that are winning. I get that. Who doesn't only want the ones that are winning? But you never know. Nobody has been able to accurately predict when one sector is going to go in or out of rotation and assume leadership. So the best way to smooth your returns is to just own all of them. That's the basics of asset allocation. I had a colleague once who said, if all your investments are moving in the same direction at the same time, you don't have an allocation, you have a bet. And bets are risky, whereas asset allocation and diversification smooth out your return. Thanks again for watching today. I will have a brand new website up in the next few weeks, and I will have some ways you can work with me. More on that soon. Thanks again for watching.